might be wanting to listen to this. You got superannuation, you got 30 years. If you put $10,000 in 1994 in cash, 30 years later, how much do you think it's worth? $34,000. Now, that's a risk that you're not going to have enough to live on.
There used to be a lot of cowboys out there. The first one that people often say, I could just put my money into a brokerage account and accumulate. Why do I need a financial advisor?
We know what we know, and the general population don't know what they don't know. We are financial architects. We need to understand what you're trying to achieve at your time in life.
These conversations need to be had at some stage. And I think having an advisor and a planner who can do that is absolutely vital. After I came to that realization, I'm just saying, okay, there's just so much more value that we can bring to the community. Hi everyone, welcome to another installment of the Investing for Doctors podcast. Today we have Roger back with us. And as you know, he's our in-house financial advisor / planner. And today we're gonna debunk some myths and also probably some complaints about the financial service sort of industry. Yep. All right. So, Roger, for those who have not met you, give us the two-line intro.
Two-liner again. Okay. I am a financial advisor / planner, as you said. They are the same thing because that is a question that everyone gets, and I was surprised. But yes, planner, advisor, they are protected words, so you can only be licensed to use those words, by the way. In your title. So I've been providing advice for coming up 25 years now, or 25 years in the industry. I've been 24 years I've been licensed to provide advice. Done the rounds on small business advice, to retiree advice, to buy-sell advice for businesses, all those types of things. So I've done the whole full gamut in those 25 years.
Yeah, got lots of experience.
So I'm a GP, a specialist GP in everything. I think. I don't know, but no, I've had a good. The only other area I think I've told you that aged care is something I have not delved into, because
you may be forced to with some of your clients.
I may be forced to, but we'll see how we go.
Excellent. So today's episode is going to be a bit different compared to the usual one. It's about debunking some misunderstanding, myths, and also complaints about the whole sector. And we've probably touched on this conversation previously. There used to be a lot of cowboys out there, and maybe I will start off with the first one that people often say. It's like, oh, I could just put my money into a brokerage account and accumulate. Why do I need a financial advisor?
Yeah. A lot of people do say that.
A lot of people do say that, isn't it?
Yeah, they do. Look, I find it throughout the 25 years, I found it quite interesting. Almost having to justify of who you are and what you do. It's because we know what we know, and the general population don't know what they don't know.
Yes.
So I like to explain what financial advisors are, and we can go back to the cowboys and what have you. But I explain what I do, and financial planners in general. I believe we are financial architects. So we need to get your briefing like you would if you were building a house. So your briefing is your goals and objectives. So we need to understand what you're trying to achieve at your time in life, what life cycle you're at. Younger, starting a career, or mid-career, late career, kids, deaths, divorces, marriages, all those types of things, what your goals and objectives are. So we need to find out what your outcome you require, what you want. So I need to design a plan or a draft that actually provides you that outcome with the resources that you have available to you. Now, the products that they use, and that can go down the path of, leading into product problems and product flogging and all those types of things. I mean, many years ago, yes, there was product flogging in the insurance space and what have you, but you still did need to know what product A and B and C did do for you. But getting back to that analogy, like an architect, I explain it like, I need those parts, or I need that gyprock, I need that color blonde or whatever to build that plan for you and present it to you and saying, these are the parts you need to give you that house that you want, so to speak, in the metaphorical term, and give you that outcome. So I need that investment product. I need that insurance product for you. I need this. And for your kids, we may need these bonds over here and all those types of things. So it's a financial architect, the way I see it.
And it's more than just, as you mentioned there, flogging a particular investment product where you just take a clip on it?
Well, years ago, there used to be commissions in investment products, super products, investment product, general managed funds and what have you. But there always has been insurance, in life insurance. Now, I'll go back
So let's break up the two. Life insurance is
we'll leave that over there for now.
Because that's a risk sort of product. And then there's a
mindset that goes with that as well.
Yeah, and then there's accumulation.
So with the investment side of things, yes, whether it be super, inside super, outside super, there used to be like commissions that you could get upfront commissions from the product provider. It could be like 3% or something.
Right. Of the total invested.
Of the total investment.
Oh, that's a lot. Yeah.
Yeah, and then they generally, this is before 2004 when you had to do financial plans. You could do what they call the CAR, which is customer advice record, which is about 8 pages or something. You still had to disclose things, which is fine, but they reckon it did allow the client to make an informed decision. But anyway, so people used to just put you into these products and they get these 3%. But what they do is the client would end up paying because they put for the first 3 years or what have you, the investment manager will put the fees up high on the product to compensate. The fund managers pay the advisor, say 3%, whatever that represents. They will put their fees up to compensate that payment. Then after 3 or 4 years, once they've been paid back, they'll bring the fees down.
The management fee.
And you'll
get the product management.
The product management fee, the management expense ratio, whatever you want to call it. But there is a trail that goes along with that as well, a small trail. So that trail they're getting, you would expect a bit of service.
Yeah.
I would, but then a lot of people weren't. They were just flogging products and just getting that 3%, 3%, 3%, and 3%, and really not being overly professional and compared to nowadays. Just trying to flog a product because they get the upfronts, just selling commission on things on commission.
Yes.
And that's when that did, I guess, bring in the FSRA, which is Financial Services Reform Act in 2004, which came and said you had to provide a statement of advice and provide options and different types of options of different investments and explain why this is good for the client. But then in 2013, moving on to 2013, then the FOFA, Future of Financial Advice Act, come in where they cut off all commissions in products going forward.
Yeah.
But any products that were had trail commissions and everything up until that date, they were grandfathered, and you whoever owned them, you could keep them, but you still weren't obliged to provide advice. But with the ongoing fee for service, you have to provide ongoing service. From FOFA, you had to provide ongoing service. This was 2013. Then the Royal Commission came in 2018, which totally removed. They actually removed all those grandfathered commissions, just took them away. And some other commissions and what have you, and that was prompted by fee for no service, because a lot of licensees, not the individual advisor, but the licensee who owns the AFSL, they were still taking fees for clients, dead clients. So there's what they were calling a fee for no service. So now it's mandatory, and since then you've had to do an opt-in where every year you need to provide a statement showing an FDS called a fee disclosure statement saying for the last 12 months you've paid X amount of dollars from this bank account, that product or whatever it may be. You're entitled to all these services in one column, and then it says received, yes, no, yes, no, yes, no. So then the client could look back and go, well, I paid X and I'm getting this service, great. And you have to do that every 12 months and provide the annual review and ongoing service, which is great, and we charge a fee for it. There's no trails, so it's an agreed fee. Then you've got to opt in. The clients, if they want to continue with you, they need to opt in again for the next 12 months to say, yes, I wish to continue with you, my relationship with you, and pay you these X fees, and I expect the same service. But then you've got to do that again the next 12 months later and say, this is what you paid for the last 12 months. So they're changing the rule, and that you don't have to keep going back and saying what you paid.
So that sounds, that
now
sounds
they're just
a bit
saying
painful.
one statement per year saying going forward you're going to pay this and these services you're going to get. So trying to reduce the red tape and the paperwork, but still make sure the client is getting fee for service.
So then it comes to that a contentious issue that always gets brought up in the group is this like the idea that all financial planners and advisors would just take a percentage of the funds under management. And obviously as the pool gets bigger and bigger and bigger, they take up more and more, even though the advice would not be necessarily more or
warranted, needed,
or needed, because once you've set up the structures, it's almost like a set and forget until you review, and if you need to change course.
Things change.
So
circumstances.
Obviously, not everyone operates that way. You don't operate that way.
No.
and give us the rationale for, for that model. Is that based on the legacy system of how people used to think?
I think it's a lot of the older guys do that. I mean, I'm not so spring chicken myself, but the older guys, they would have a percentage base on the amount of money you have invested with the client has invested with you. Now, if that grows as you understand, so does your fee. But then, what extra
value,
services, value are you providing for that extra income? And some would say, well, it demonstrates to the client that I've got a vested interest in your portfolio going up. Yeah. But then, if the portfolio goes down, I get paid less as well. I'm thinking, yeah, but is that all you do? You don't just look after the portfolio.
Yeah, but then there's also other things, right? Other things like, if you were to give advice on
other areas of their life,
properties or other areas of life, or, structuring and that sort of thing. It's like, where is the value for that coming from? Is it still coming from that percentage?
That turns that into meaningless, intangible value, no value in that at all. Well, that's to me, that's the most value.
Yeah.
Because our system, as you know, we charge a flat fee, and that covers for us to look after the portfolio, yes, of course, and to look after all the other aspects of your life and life changes that you may need advice on, such as having a baby, getting divorced, all those types of things. You got to pay rise. What should we do with that extra money? Should we put that into super? And that's super's just a tax structure, so we don't need to worry about the portfolio yet that's in there. So, they can create tax deductions for you. So there's so many areas. Like I said, an architect, there's a kitchen, there's a bathroom, there's a lounge room, there's the bedrooms.
Yeah.
It's all these areas of your life that you look at. So to me, I've always felt that when people charge a fee-based, it just diminishes all that valuable advice over those other areas. And
which seems to be more valuable in my opinion.
It is, because first and foremost, I have learnt from older guys, which are really good ones, when I was younger, that the first thing you should say, who owns the asset and how is it owned? Not what you're invested in, who owns it and how first. Then you go into the investment. That's the easy part.
Yeah.
So that's why I feel that, and also with the fee attached to the market, as I said, it diminishes all these other valuable advice here, but it ties you to the market.
Yeah.
Like that
it ties your remuneration to the market.
Well, it ties your remuneration, but ties you to the market like it's your fault.
Yeah. So you
can't control Donald Trump, what he does. No one can.
No, you can't.
No one can.
Yeah.
So it's what we can do is like no one can pick winners. No one can pick the tops and pick the bottoms. But what we can do is mitigate risk.
Yeah.
So we can reduce the risk from our education and experience, and obviously facts on history and how the characteristics of investments and world events and all those types of things. Where we can say, well, we can minimize minimize risk based on your time frame and your time horizon. You might be coming up to retirement. So I don't like the word risk because it's misunderstood when it comes to investments. Because if you cash can be risky.
The risk is not earning enough.
You stole my thunder there. Thanks. I was waiting for the gasp from everyone. But if you're a 30-year-old, and you're working, you got superannuation. You might be wanting to listen to this. You got superannuation. You got 30 years, and you got invested in cash because I'm scared of the market because you negative connotations have been fed to you, which is not true.
Yeah.
You got 30 years. If you put $10,000 in 1994 in cash, 30 years later, how much do you think it's worth?
10,
just compounding and everything. $34,000.
3 times, yeah.
$34,000.
Yeah.
Now that's a risk that you're not going to have enough to live on.
Yeah.
No way, because your time frame is not right. If it was for 1 year, of course, everyone knows that. Common sense. 1 year, you put money in stocks for 1 year, you're crazy. Everyone knows that. So it's all about your time frame. So you got to make sure that that's understood, and that's how we mitigate risk.
So do you feel like the percentage fund under management model is a little bit lazy?
I think it's a little bit lazy. I don't think it's good mindset. It's a real mindset for me. As I said, it just ties you to the market, and clients think that you are the market. You're the stock picker. You're not. You're the risk mitigator. That's what you are. So I like to look at it as it is a bit lazy. I think it's a bit redundant. I don't think it's professional. I hope I don't offend any other advisors out there, but I just feel it's, because the industry's we're trying to lift our public perception even higher and higher professionally. And I don't think that's helping because it still sounds like a commission thing. It sounds, to me, it just doesn't sit right with me.
And my biggest gripe with it is that it doesn't, reward the advisor for, all the other activities or
value it.
Or value it. And what happens is that you will preferentially, allocate funds to products that you can control and have a percentage on.
And it's not in the best interest for the client.
And that is not, exactly. And that is not in the best interest of the client, because one of the feedback that I get when some of our, members go speak to financial advisor is that they do not even want to talk about property, for instance, or they don't want to talk about more contentious stuff like crypto or more contentious things like startup investing, venture capital, that sort of thing. They don't want to talk about it because there is no percentage AUM extraction from those investments, right? And so by having a flat fee and fee for service model, I think that works a lot.
And we list all the services that you get for that fee. So there is a couple of bands.
Yeah.
So you can see exactly what you're getting and what they're paying for. And people can move up and down that scale depending on their life stages as they progress through life with us. Yeah. So property, I love property. Shares have their place, property have their place.
Yeah.
And again, it all comes back to the client. What's the best for your client? What's, such high net worth income earners, when you're trying to bring down their tax and you maximize any other resources, property can be great. Brand new properties can be great because they have a high depreciation level up front.
Yes. Yeah.
So you've got to make sure that's considered as well. So and that they're great for you. Plus the banks don't mind lending to for property. Well, property rather than shares that are a bit more.
Shares are hard to leverage.
For property is a lot higher than they would for shares, because you can see it, feel it, touch it, and what have you, and all that type of stuff. So they have their place. Shares have their place. I've had some retirees who got rid of their investment properties. Now they're all in their managed funds that I've created for them because there's just no work anymore. They don't have to deal with real estate agents. They don't have to deal with tenants and repairs and all those sorts of things because they built their wealth through that.
Yeah.
No, don't get me wrong. But now they don't want that, have to bother with that, and they just let me manage everything for them.
And exactly that point. I feel like that criticism is often leveraged at people who only approach financial planning from a wealth accumulation perspective and none of the other perspectives.
Oh, that's probably 20% of what we do.
Exactly.
Really?
Exactly.
But there's there's a lot of knowledge to do that. But again, get someone experienced who's been doing it for quite some time, so they do have that experience to specialize in that, and all these other areas of structures, because structures create different tax outcomes and estate planning outcomes and what have you. So that's another consideration.
Yeah. So the estate planning, and as you know, we've had a couple of doctor members that have approached you from a whole of family and parents side of things, because as you get older, you as the recipient of potential future wealth, especially as the boomer generation's retiring.
That's right.
Your parents are retiring. Some of them might be on the pension or may not be on the pension. You need to also, if you're a good child, I guess, you consider what's happening with your parents, and they will consider what they need to do from a wealth transfer perspective as well, because there's so much in there.
Yep.
And I just feel like that's something that's not talked about.
No, well, it is amongst the advisor fraternity.
But amongst accumulators, there isn't much.
Yeah, but when people are at that stage, there is estate planning tax considerations by the way you put money into super. Because if super goes to your spouse, what have you, by the ATO, they're a financial dependent and it's all tax free. Right, or financial dependent. Really is the terminology. But if that goes to adult children, depending on how the super's put in, they can be taxed on that when they're getting zero tax, and you're going to give it, you give it to your kids. You've got to consider how you put that in, because if you put it in as a non-concessional contribution, it comes out with no tax. So you've got to try and find that balance. And also, little stories like this will tickle your fancy as a doctor.
Good.
That on their deathbed, you say this, we're on the deathbed, you say to the client, I think you should draw all your money out now while you're alive, because you could bring it out tax-free, then give it to your dependent, because then there's going to be no tax implications. If you die tomorrow and do it tomorrow, well, you can't because you're dead, then there's going to be a big tax, 30, 40 grand tax. Do you want to bring it out now? Yes, okay, sign here, take it out. I know it seems funny to joke, but it's actual what happens.
Is that what happens?
That's what happens. If you get lawyers joke about that, say don't die yet. Just wait till we sign the documents, then you can die, type of thing. And we'll get the money out, give it to your kids, and you're okay. But that's the real value in advice to me.
Yeah.
It's things like that people just don't understand. Like, you just keep thinking the word architects, and it might sink in that there's just so many other areas. And think of a house, bathroom, what's that going to look like?
And I think it's really changed my view on it because, as my parents are starting to get older, I'm thinking about what they need to do from, their succession planning, their retirement, and how that impacts me, and how what I do today might impact them, and vice versa.
Absolutely.
My parents are overseas, so it, just makes everything 3 times more complicated.
Yep.
But, these conversations need to be had at some stage. And I think having an advisor and a planner who can do that independently of that, parent-child relationship is absolutely vital. And I think after I came to that realization, I'm just saying, okay, there's just so much more value that we can bring to the community.
Yeah, and that's because I feel there is, and I've seen it. I've been doing it so many years. I've seen it and do it, and I don't think I'd have ever charged AUM. I think I did early on because the guy I worked for did it, but then I soon changed my mind and realized that just doesn't sit right because there's so many other things that just get swept under the carpet, which are very valuable.
Yeah, and perhaps they don't want to even touch on that. Like the example I gave you, they don't want to talk about properties because there's nothing they can extract out of it. Yeah.
So, but, and on that, there's a massive wealth transfer going on with the generation in this country because of the retiring population. So, all advisors got to, get on top of this and have those conversations, because I've got a lot of retiree clients, and some of them, their kids are becoming my clients, and that makes it easier to have those conversations
when you have the parent-child.
The estate planning implications. So that's what I said, and you become sort of like a family coach, a family friend, because you get to know them all very well and personally, and they welcome you all the time. You call them, and and I'm friends on Facebook with a lot of them, what have you. So there's your value. Like, it's, again, talking about the value, a financial advisor can obviously stop people from making mistakes. You can actually, if I went to a doctor and said, oh, should I take this? They always say on medicine, consult your doctor before you take this. Yes. It's the same sort of thing.
Same story, yeah.
You should consult your financial advisor before you make this decision, which they do when they advertise in PDSs and what have you. But you should have that mindset, and that's what we are there for. We're like I like to explain it like you're the CEO, I'm the CFO. I work for you. And remember I said that yearly you've got to keep signing me on type of thing. If you want my services and you see the value in them. But I tell you, no, that's a good idea. No, that's not a good idea. I recommend you do this. I've looked at this, and looked at this, but I reckon this is better for you because I know you. I know you've already told me what your goals and objectives are. So no, it's very much, I believe, how a doctor would sort of think is like, we've got to get you better. Are you allergic to anything? No, you can't have those.
Yeah.
So you know what I mean? Yeah. So I see it a bit of akin to it.
So it sounds like, there's also that role of looking at things that are potentially investable that people bring to you, and I think there was some some fraudulent products in that's gone through the market and was in the news. Do you care to? I'm
glad you brought that up, B. Because I probably 5 or 6 years ago, I had this lady. Anyway, I can't remember this lady, she wanted me to provide some advice for her. She again did have some ETFs going on and what have you.
Was she already your client?
No, she wasn't my client. This lady was not my client. She contacted me, it's like I said, 5 or 6 years ago. I can't remember how she got through to me. Anyway, she got through to me. She had some investments in place like ETFs and what have you, like the Vanguard, the VAS and all those types of things. But she wants to expand and all that type of stuff. And she wanted just like a page of doc, give her advice. Like, that's not how it works. So I said, either this is how this process is, this is the way we do it, or we don't do it at all. Because it's covering my butt, and also what they call a safe harbor, making sure that she's getting all the right advice. Again, like in you asking someone, what are you allergic to before you prescribe something. So anyway, she went down the path, said, I don't need you to put it in place for me or manage it going forward. I said, okay, all right, I don't do this, but all right. I mean, what I say I don't do is I usually don't just provide one-up advice and see you later. That's not my model. My model is ongoing relationship with the service going. She said, oh, by the way, I've got this investment. It was an Australian Financial Review, so I can say it. It was a Citibank bond. And she had the PDS. And I thought, oh, okay, send it through. She said, I want you to have a look at this because I want to invest $100,000 into this. And I go, oh, okay. So during my my further recommendation, the SOA, the statement of advice, she wanted to incorporate that. So I said, all right, I'll have a look at that. I'll look through it. Anyway, so I got the PDS. It looked beautiful, absolutely. But there's one thing on the back of the APRA, Australian Prudential Regulatory Authority. One of those letters was mixed up. So one of the licensee guys looked at it and said, "Oh, that's weird. Did that have a typo? Usually they don't have that simple typo, right?" Anyway, so they're a bit suspicious. Anyway, and I eventually called the guy up and got through. And it was an English sounding fella. And I was a bit suspicious about how they worked. Like he said, it's a bond paying like a 1 year bond or something, paying 6.5% or something. This was when rates were down, and also this tax-free implications of it. I'm thinking, hang on, that's two different products mixed into one, but they can't work that way. That's not how they work. So I'm ringing up, questioning him, and I'm sort of almost putting words in his mouth. Said, "Yeah, that's right. You know them better than me." And I'm thinking, you shouldn't be saying that. You know them better than me. When it's his product. So anyway, I kept investigating, and I was just holding off, and she was getting cranky saying, "Come on, where's my plan?" And I was saying, "I'm not comfortable yet. Just wait. I need to research this. It's not sitting right with me." And then one morning, one of the guys from the licensee called me up and said, "Go and get the financial review. Go look on page 5. Big thing, Citibank fraud. Fraudulent. It wasn't Citibank, but it was covering a Citibank, obviously.
Yeah. They're pretending to be Citibank.
Pretending, and I was just like, oh. So like I didn't need to, because I just didn't sit right, and and the licensees are going, "Oh, it doesn't seem right." You know, the old story that if it's too good to be true, it generally is, but it looks so professional. You say almost fooled professionals, almost fooled us.
Yeah.
But then again, I called her up and said, "Go get the financial review," and I showed her, and she went, "Oh my God," type of thing. And I said, "Well, I'll finish your statement of advice, but it's not going to include that for sure."
Yeah.
So we went. But the bottom line is, I saved her $100,000, and she had told me other friends of hers were looking at it too. And I just said, "You should go tell your friends, go read the paper."
Yeah.
But I saved her $100,000, so there's $100,000 worth of value there.
Yeah.
Really?
Yeah.
But I didn't charge her that. I charged her 0.3% of that. If you want to go on percentages, $3,500-$4,000 or something. Was a good money spent to, save 100.
Yeah.
So that's the type of things that advisors provide. So they, there's in 2018, there used to be 28,000 advisors in Australia. Since the Royal Commission, because of the changes in legislation, the red tape, the education standards far higher, all those types of things, they say about 15,500 at the moment, but actually they seem to think it's only about 11,000 active, full comprehensive advisors. So there's not many. And the ones that the ones that are left, I think they're like chicken's teeth. So they're very, and you can easily research them. You just go to ASIC, put their name in. You can go to the FAAA, Australian Financial Advisors Association, it's an amalgamation of two other associations. They should be listed on there. They're very easy to research, financial advice, and they should have, must have an ASIC advisor code, AR code, authorised rep code. Mine's 250443. Look that up on ASIC and you'll see my name come up, and then it shows you any complaints or discrepancies or anything like that. And education's kept up to standard, how long you've been providing advice, who you've been licensed with. So I always encourage
I've got that code as well. Yeah,
I just say go and do it. Go look up ASIC, So which I just gets that out of the way. But I feel that the ones that are left, I think, you'd be pretty hard to find someone who's not honest. I'm not saying that's not going to happen, but it's pretty hard. You'd have to be, I think, pretty blind to not being able to spot. Dodgy.
And I guess that's why a lot of people say, "Oh, I've had some chats with these people and it just doesn't sit right with me." And I guess this is like it's like dating, right? You got to find the right person to work with you on your journey
and have all the same goals and objectives. Which is beliefs.
And well, I mean, the financial incentives needs to be aligned.
Oh yeah, sorry, exactly right. You do. I'm just trying to think of some of the comments as well. Like I have clients where I work with, and another big part of what we provide, which is sort of intangible, but I think has great value, is the education that we provide going forward on that relationship that you have on a year-on-year basis. Is because we provide certainty, provide research. We do it 24/7, just like another professional doctor.
Oh yeah, absolutely.
That's what we do, and it's the and getting back to that, because as we know that human beings fear what they don't understand. So my philosophy in that is I take it slow with clients initially, and I start on an education process quite early, fundamentals of just what is a stock and what is a managed fund, what is the index, what are the markets, what's the ASX, all those type of things for a start, because everyone knows what property is in this country anyway.
That's an easy thing, right? The rest not so.
So I explain, but the point is I get clients eventually become educated and sophisticated. So then when we get to the stage where we need to do something more sophisticated, they don't fear it.
Yeah,
because they sort of they've been educated on the way. Then it's explaining.
We know the lingo.
Oh yeah, I understand that.
Yeah.
I get it. Yeah, I get it. They understand the pros and cons of risk, reward, all those types of things. So they move into it with informed decision, which is that cliche, but they move into it with confidence.
Yeah.
And I move into it with much more confidence, knowing that you understand what we're talking about, what we're doing, and everything's clear. Do you know what the risks are, the implications are? I don't like to use the word risk, but we have to use it.
Yeah.
But you just know what can happen and what happens, and if you get the point, I think.
Yeah, of course.
So,
and I'm gonna bring out one last. I would call this one a complaint, right? It seems that a lot that were under the fund, the fund percentage fund under management model. The one thing that they love to do is take out someone's super and put it into another structure and to manage that directly. Now, I'm gonna, from my perspective as someone who I would say is relatively financially savvy, I would say often that may not be the best option to go, because if you are in the right amount of, sort of risk return category in your existing fund, why are we pulling all of that out, putting it into another fund, adding a 1% or, whatever management cost onto that?
On top of the already management cost of the funds.
Exactly. Is that, I guess, a value extraction mechanism for the advisor, or is there something I'm missing that is actually beneficial?
Well, there's two parts to that, but I think what they're focusing on, and I hear on the radio, which really annoys me, saying, financial advisors want to take it out of your super and put it into their superannuation fund. What does that mean? I explain, my licensee, for instance, and other licensees, they create their own MDAs, management of discretionary accounts. Okay, so they can create these funds like high growth, balance, and so on. And they manage that, which is fine. And then you could put your money into there, and then it's sort of like it's helping the licensee, but you don't get anything out because you can't get a percentage. But you can still charge your percentage on top of that, like an AUM if you wanted to. So I'm going to do, but I feel that's really only aligning yourself with what the licensee would like you to do, but the licensee knows you've got to do the best interest of the clients. And sometimes that works. But some people might take someone from an industry fund, because some industry funds don't pay you an ongoing service fee. Even if the client's willing to do it, they don't have that mechanism to do it. They're starting to do it now. And then you take it from that one and put it into this one, a retail fund, where I know I can charge you an ongoing flat fee or a percentage, it doesn't matter, either one, and then manage it. But then that's because over here I can't get them to pay me a fee.
Well, why can't they just get the fee from outside of?
Well, that's another thing. You can get the client can pay it directly to you, which is fine. But sometimes, you find people a bit cash poor.
I see. And I've seen instances of this where the issue is that they can't take anything out and they don't want to pay outside of their super.
Yeah.
Whereas you can't get it out from the super fund, so that's a way for them to extract it, I guess.
To move it over here.
Yeah. Do you think that will change? Because I think in last year, towards the end of last year, there was a guidance from the ATO that says now financial advice could potentially be tax deductible.
Oh,
and
okay.
Then you don't get that taxation issue.
No, that's another topic. But I can touch on that. But just getting back to that, with the DBFO, they call it now, which is still working through the government to reduce red tape and be able to, in a turn, reduce costs, so the average Australian can get some advice, so we can bring the costs down to get it out to them. Is that allowing industry funds to pay a non-aligned financial advisor an ongoing fee if the client's consent and all that type of stuff. They just didn't have the mechanism, didn't want to do it.
So now there is a mechanism.
Some are putting in mechanisms. I think they'll all do it by a year or so.
Yeah, because they're losing clients.
They'll lose clients that way. But also, there's a lot of things that could be restricted investments within an industry fund. But over here, I build portfolios here, which I'm not going to explain my IP right now. Clients get that IP of why it's done over here. But again, with an SOA, statement of advice, you have to prove that you're putting the client in a better position. And you have to do that through an SOA, and your licensee checks it. And you get audited. We get audited all the time to make sure we're providing advice. We've met all the regulations, done all the things. The outcome for the client. So you really got to be pretty good as to have a good damn reason as why you're moving from the A to B.
Yeah.
A very good reason, substantial reason, like considerably lower fees, better investment options that are actually valuable to the client and is providing an outcome for them. Yeah. But getting back to the tax deductibility, the ongoing fees is tax deductible.
Yeah.
Okay, to the owner, to the payer.
Yeah.
So if you're paying out of your pocket, which is good because you're in a high tax bracket, then you get that percentage back. You're 47% back of $100, say. But if your super fund's paying it, the super fund rate's only 15%. So the fund only gets back 15% of your fee. But then they got your pros and cons. It's easy for their cash flow. You might have a young family who's cash strapped because they've got paying a mortgage.
Yeah.
So you've got to balance all these things out. But getting back to the deductibility, with financial plans now, how it works is generally a financial plan fee is not tax deductible. I'll come back to that. And there's an implementation fee. It's not deductible. But what it is now, if the advice provides income protection advice, insurance, we're back on the insurance, income protection, what percentage that premium represents the cost of your plan, then that's, say 50% of the advice was only on income protection, the other 50 was on something else.
Yeah, so the income protection part.
So that's saying, just easy numbers, 50% of that fee, whatever it may be, $3,000-$4,000 percentage is tax deductible.
Yeah.
All right, because it's related to income protection.
Yeah.
All right. Is that
That's clear.
Yeah, it's pretty much that. Whatever that represents, percentage of the premium costs is a percentage. You just put the same percent onto what the deductibility of the upfront plan.
So I guess my point with the tax side of things is that if it was within the superstructure, it's tax efficient, and then if you did it outside, it wasn't tax efficient, even though you could have had the cash.
That's for the ongoing fee?
Yeah. Well, yeah, for the ongoing fee.
No, even if it's in super, you can still claim it.
Well, yeah. So in super, you can claim it. But then in outside of super, can you?
No, there's a new rule now.
Oh, right.
That if you whether it's in whether the insurance is in super or outside super, the income protection, because you could have it in super, it's still deductible.
No, I'm talking about the management of your assets. The management fee.
It's deductible. It's tax deductible to the payer.
Yeah.
Whether it be you or your super fund or your trust, or whatever it may be.
So that's good now and may
that's been around for a long time. The ongoing fees.
Yeah,
but like the new one that's just coming now, the upfront, which never was.
Yeah.
Well, the upfront, let's call it this financial plan fee. That is deductible in relation to the advice of the income protection within that statement of advice.
Yes. Yeah. Exactly. Yeah. All right. So I mean, any other critiques you've come across about the industry? I mean, I'm sure there's lots, but like, what are the major ones that you feel strongly about that you need to address?
Well, I've felt, like I said, I just don't believe in an asset-based fee. We've gone through that.
Yeah.
Insurance is something that, again, insurance can be very complex. The structure, again, it's all who owns what, in what manner.
Yeah.
So insurance, they used to churn back in the old days. They used to churn because you get upfront commissions.
Yeah.
But now the commissions are half the upfront commissions, which they all are called upfront commissions, which are now practically half of what they used to be.
Yeah.
And the reason why you get commissions is because people generally don't really want to pay a financial planning fee for insurance advice. It's something that's not tangible.
Yeah.
But again, that's why that income protection deductibility helps now.
Yes, of course.
It really helps. But also that is something that it's not a product flog. They are just a tool, as I said, to manage your risk.
Yep.
You're transferring your financial risk to an insurance company. That's what you're doing. So if you're a young person starting out, you got a job, you need to protect your income, protect your ability to earn an income with income protection straight away. So like I would just say, pretend you're an ATM. If you had an ATM, you'd insure it, wouldn't you? You keep spitting out money.
Yeah.
So again, insurance is the thing that's misunderstood and think it's a product flog. It's not just a tool to manage your risk going forward. Then you can build your wealth on top of that.
Yeah.
Your strategy, because that underpins that strategy.
Yeah.
Because if you're earning money and projecting a superannuation is going to be X by the time of 60 and you become TPD'd and you can't work for up to the age of 65 when you're only 30, you get your income protection. You might only get 75% of your income for the rest of your life, but at least you're still heading that way.
Yeah.
But you might not hit up here, but you might hit there.
Yeah.
And if you had none of that,
adjust your plan.
And if you had none of that, nothing.
Absolutely.
So that's why risk insurance is fundamental. To me, it's the foundation. And then you build on top. Of course, when you're old and you've got no debt, it's irrelevant.
Yeah.
So that's why, again, advisor has these chameleons. They have to be the scale to understand your life stages and what you need.
Structuring,
and
taxation,
from
all these things.
18-year-old kid to 65-year-old retiree. There's so many different needs that you encounter along that life path and life stage and life events that require different pieces of advice and very tangible, valid, life-changing pieces of advice.
Yeah. So if you're just wanting to open a brokerage account and buy a diversified ETF, you don't need that.
Go for it.
Yeah,
if you want
exactly.
To do that.
You can just DIY.
If you're a young person, most advisors won't charge you for initial consultation.
Yeah.
Right.
So have a chat.
Have a chat to one for an hour. They won't. Well, not many. I don't charge a fee for that. And I'm happy to talk to someone and give them a few pointers and what have you, but without giving advice, but just saying you should make sure you've got income protection, which is not advice. It's not a particular product. It's a suite of products. Yeah. If you want to just start investing, just you can. I could direct them to. I could just push them over to you can go to ComSec or anywhere.
You just go one of the brokerage websites,
and I could just refer to websites. Say this is without giving product advice. I'm happy to do that. But when I see someone has true need, like I've had a client the other day, massive need. It was earning a massive amount of money, 3 kids, mortgage, all those types of things. And of course all these things are running through my head of what I could do for her because
So ideally, the person who comes to a financial advisor needs to have something there that you can build on, because if you
the more problems they've got, the more we can help.
Yeah, exactly. If you're just a blank slate and you're trying to save up $10,000 to invest in some stocks, there's really not much point there, is there? I mean, there's some basic things that you can do, like optimize your super, make sure your income's protected, but really it sort of stops.
But for those low-level things, you have enough education on the internet to get that. But just call an advisor.
Yeah, just call them.
They'll give you. Most of them will give you an hour.
Yeah.
Because in 5 years' time, they might need your services and they'll come back to you if you want to look at it that way.
Exactly.
So it's like you're incubating people for the future, knowing that you're in there to help because you just said, here's some tips.
Well, I mean, for the viewers out there, you know where to find us. Give Roger a call.
Investing for Doctors.
Wherever you're at. And I think that's
Well, I hope that covered everything.
I think that covered all of the gripes with the industry that we've seen from the community and sort of the social media at large.
Yeah. I'm glad we had an opportunity to talk about that because it sort of. I grit my teeth a little bit and thinking, if I could just get you 5 minutes or half an hour, I could explain all that to you, your misconception.
Now this is the open call for,
That's right.
if you, I will challenge you on that belief, and if you dare, give us a call.
Well, give
Roger
me a
will
call.
change your mind.
I have dabbled a little bit on a couple of responses, but I thought, I'll just let B do it. I'll stay out of it.
No problem.
But anyone, feel free to call.
Excellent. Thank you so much for coming in today.
You're welcome.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.